Thank you for listening to the Real Estate Boys podcast. I'm Vernon Arya Jones, managing broker, owner of Jones Homes. And for over 33 years, we have serviced the 7-county Denver metro area. Well, the economy, and what is it doing? A vast swath of the U.S. economy is showing signs of weakness as unemployment rises to its highest point in more than 2 years. The Institute for Supply Management's latest monthly survey that gauges economic activity in the services sector showed that so-called new orders and overall economic activity unexpectedly slipped into contraction territory last month. The headline index fell to a reading of 48.8% in June, down from 53.8% in May, as the new orders sub-index saw an even steeper decline, down to 47.3% from 54.1%. And just to give you some substance, a reading above 50 indicates expansion. Anything below 50 points to a contraction. The apparent slowdown in demand, if it persists for long enough, could translate into service providing businesses hiring at a slower pace and possibly cutting some jobs. The overwhelming majority of employment in the United States is considered service providing. Specifically, 86% of the basic 159 million total U.S. jobs as of June. When you think of services, a lot of it is driven by the consumer, and consumers are key where the U.S. economy goes. The U.S. economy is indeed under pressure, grappling with still high inflation, the highest interest rates in more than 2 decades, depleted pandemic savings, and a growing load of debt. I mentioned this in one of my email newsletters and also one of my podcasts that consumer debt is around 1.3, 1.4 trillion, the highest it has ever been. Consumer spending, which makes up about 70% of the U.S. economy, has already moderated over the past few months, government statistics show. And retailers themselves has said they notice shoppers across the income spectrum changing their purchasing behavior. A food services business survey surveyed by ISM said that sales and traffic remained soft compared to last year. Spending at restaurants and bars declined 0.4% in May, according to the latest Commerce Department figures on retail sales. A retail company told ISM, "Will customers have enough discretionary funds to spend?" Americans in the top 20% of earners were responsible for a large share of spending on services related to transportation, say air travel and cruises, recreation, food, and finance. The bottom 60% of households by income accounted for a larger portion of spending on healthcare services. But it takes time before slowing demand translates into slower hiring or layoffs, because businesses have to determine if they didn't just deal with a bad month or two, or perhaps a bad quarter. Service providing businesses have already been hiring at a weaker clip. These firms have added 168,000 jobs a month on average from April through June, according to Labor Department data released just this past Friday. That's much lower than the average for the prior 3 months, from January through March, which is about 241,000 jobs. Last year, the average monthly job gain in the service industry sector was 228,000 jobs. Hiring trends, of course, vary within the services sector, again, which is a huge slice of the job market. Last month, retail trade employment shrunk for the first time since November, while temporary help services contracted almost 50,000 jobs, dragging down the broader professional and business services sector, which lost about 17,000 jobs. Healthcare has been one major bright spot for the services sector, adding jobs at a brisk pace for the past few decades, excluding a drop-off during the pandemic. But even then, some businesses in that industry have recently noticed softening demand. Demand for services has moderated after near record patient levels in the last month. The job market staged a stunning comeback when the broader U.S. economy recovered from the COVID-19 pandemic, eventually leading to unemployment falling to a half-century low of 3.4% in 2023 for the first time. It's loosened up recently, however, with unemployment now at 4.1%, the highest level since November of 2021, and new applications for jobless benefits on an upward trend. Fed officials are keeping a close eye for any alarming signs of weakness in the job market. They're saying it now, as they wait for further evidence that inflation will continue to slow without an unexpectedly hot economy sabotaging that. How does that affect mortgage rates? I talk to people all the time and just say, labor market and mortgage interest rates, they are intertwined. What the Fed wants to do as far as seeing the job market cool, you will see interest rates start to lessen. Inflation will go down because people won't be buying as much. And then mortgage interest rates start to follow that trend where they begin to go down. Understand, a cooling job market is not bad for mortgage rates. It's good. So I would tell anybody who's thinking about what mortgage rates are going to do. I think I mentioned some time back that I expected one interest rate cut by the Federal Reserve Board, which could translate to mortgage rates coming in a little lower. Even though one is geared to one, one's geared to the other, but they kind of follow each other at some level. But I do want to tell you, if you have any questions about what I just discussed, you have our number. Thank you for listening to the Real Estate Voice podcast. This is Vernon R.E. Jones, 303-359-8218. As always, please be safe.